$9.2 billion in consolidated revenue.
Right, but net income actually decreased 12% to $904.9 million.
And earnings per diluted share dropped 5% down to $3.20.
Which is a glaring contradiction right at the top of the income statement.
Yeah, it really is. Today we are taking a deep dive into the fiscal 2026 third quarter earnings report for D.R. Horton, ticker symbol DHI.
The nation's largest home builder by volume since, what, 2002?
Exactly, since 2002. And, over their 47-year history, they have closed 1.3 million homes.
It's massive.
It's a massive corporate machine. And for you listening, this deep dive isn't just about a corporate spreadsheet. This single document serves as a real-time, ground-level pulse on the American housing market.
Right. It shows us consumer sentiment, affordability.
All of it, yeah. Viewed through the lens of this massive operation.
It really is a masterclass in how these massive corporations navigate a uniquely challenging macroeconomic environment. A company with this footprint, they don't just react to the residential economy.
No, they kind of drive it.
Right. Its internal mechanics give us a blueprint for understanding where the broader housing market is actually feeling pressure.
Okay, let's unpack this. If they are bringing in $9.2 billion in revenue, and they actually closed 23,983 homes this quarter.
Which, by the way, is a 4% increase year over year.
Right, a 4% increase. So why is their profit shrinking by double digits? Are they actively working harder, building more houses, pouring more concrete, just to, make less money?
What's fascinating here is how D.R. Horton is deliberately choosing its margin profile based on current market realities.
Deliberately choosing it.
Yeah. Executive Chairman David Auld was very clear in his commentary. He pointed directly to affordability constraints and cautious consumer sentiment.
Cautious consumer sentiment.
Yeah, continuing to impact new home demand.
Cautious consumer sentiment, that basically means the everyday buyer is terrified of current mortgage rates, right? And just the overall cost of living.
Exactly.
They are hesitant to lock themselves into a 30-year financial commitment.
And that hesitation is the primary headwind. So management is making a highly calculated choice here. They are intentionally sacrificing some of their profit margin to keep their volume up.
Oh, wow.
Yeah. They achieved a home sales gross margin of 20.7%.
Okay.
And a consolidated pre-tax profit margin of 13.3%. So, by accepting a slightly lower margin on each individual unit, they managed to push those nearly 24,000 closings across the finish line.
Which actually put them at the very high end of their guidance range for the quarter, right?
They did, yeah.
So they are keeping the factory floor moving, essentially, even if each item rolling off the line nets them slightly less cash.
That's a great way to put it.
But, what does that sacrifice actually look like in practice? How do you convince a cautious consumer to sign a mortgage when rates are so intimidating?
Well, you pull the incentive lever. Auld noted that they expect elevated, quote, sales incentives to remain a core part of their strategy through the fourth quarter.
And in this market, a sales incentive isn't just like throwing in stainless steel appliances, is it?
No. It often means aggressively buying down the customer's mortgage rate.
Oh, right.
D.R. Horton is actually taking cash out of its own pocket, paying it up front to lower the interest rate for the buyer.
Wow.
Which, makes the monthly payment manageable for them.
Which directly eats into that 20.7% gross margin.
Exactly.
They are paying a premium to manufacture their own demand.
Yeah.
And clearly, it takes an incredible amount of capital to fund those rate buy-downs at a volume of 24,000 homes.
An unbelievable amount of capital.
Which brings us to the physical reality of what they're actually building. Let's look at their inventory, because the numbers here, they require a serious double take.
Yeah, they do.
At the end of the quarter, D.R. Horton had 38,000 homes in inventory.
That is a massive portfolio of physical assets, and they're sitting in various stages of construction across 126 markets.
Right, but out of those 38,000 homes, 23,300 are completely unsold. Unsold. And the number that really jumps off the page for me, 7,600 of those unsold homes are completely finished. They have roofs, plumbing, drywall, paint, and they're just sitting there, empty.
Yeah.
In fact, 600 of those homes have been completed and sitting empty for greater than 6 months.
That's a long time to hold a finished house.
It is. Add to that the fact that they experienced a 20% cancellation rate on orders this quarter.
Right. 1 in 5 buyers got all the way to the contract phase and then just,
Walked away.
yeah, walked away.
A 20% cancellation rate paired with 7,600 finished empty homes. I mean, that paints a very specific picture of the friction between buyers and affordability.
It absolutely does.
Like, if I am a local regional builder and I have 5 finished homes sitting empty, I am sweating bullets.
Oh, yeah. Carrying costs, property taxes.
Exactly. But D.R. Horton has a fleet of 7,600 empty homes. To me, it sounds like a massive car dealership lot, completely packed full of unsold inventory, gathering dust.
It's a striking image.
Right. So isn't this a massive vulnerability?
Yeah.
Doesn't holding that much physical unsold inventory tie up dangerous amounts of capital, like leaves them exposed if the market freezes?
Well, this raises an important question about how modern megabuilders insulate themselves from the very risk you were describing.
Okay.
On the surface, sure, carrying over 7,000 empty homes sounds terrifying, but you cannot evaluate that physical inventory in a vacuum.
What do you mean?
You have to look at the dirt beneath the houses, specifically their land strategy. D.R. Horton owns and controls a staggering 568,500 total land lots.
Wait, 500,000 plots of dirt?
Yeah.
Just waiting for a foundation?
Yep. But the critical word in that metric is controls.
Control, okay.
Out of that massive portfolio, 78% of those lots are only controlled through purchase contracts.
So they don't own them.
Right. They do not own them outright. They only outright own 22% of the land they eventually plan to build on.
Break down how that actually works in practice, because, I mean, that seems counterintuitive for a company called America's Builder. How do you build on land you don't own?
Well, think of it as just-in-time manufacturing applied to real estate.
Oh, okay.
Historically, home builders would buy massive tracts of raw land, sink millions of dollars into ownership, and hold that depreciating asset on their balance sheet while they slowly built out a neighborhood.
Right, which sounds incredibly risky.
It is. If a recession hit, they were caught holding a massive illiquid bag of dirt.
Right.
D.R. Horton's strategy relies on options contracts. They pay a relatively small, non-refundable deposit to a land developer to lock in a purchase price for a specific lot.
So it's like a reservation.
Exactly. They hold the right to buy that land, but they don't actually purchase it or take on the heavy capital burden until they are practically ready to pour the concrete.
They're essentially renting the right to buy the land later.
Basically.
So if the housing market suddenly falls off a cliff tomorrow,
Mm-hmm.
they can just walk away from those options contracts.
Yep. They lose the deposit, but they protect the core balance sheet from being crushed by raw land debt. That is the exact mechanism of their asset-light approach. And we can see how they execute this by looking at where they are sourcing these lots.
Okay.
Of the homes they closed during the first 9 months of fiscal 2026, 67% of them were built on lots developed by Forestar or by other third parties.
And Forestar is the publicly traded national residential lot development company that D.R. Horton actually owns a majority stake in.
Right. And Forestar sold 3,659 lots this quarter alone.
Wow.
They generated $407 million of revenue on their own, with a pre-tax profit margin of 12.0%.
So D.R. Horton is essentially offloading the heavy capital-intensive risk of raw land development.
Exactly. The grading, the paving, the infrastructure, they leave that to Forestar and third parties.
So when we look at those 7,600 empty finished houses, the context changes entirely.
It does.
They can afford to let those houses sit and wait for the right buyer because they haven't sunk billions of dollars into owning the thousands of vacant lots surrounding those empty houses.
And the balance sheet proves that thesis out. At quarter end, they maintained $6.1 billion in total liquidity.
$6.1 billion.
Yeah. And even more telling is their debt to total capital ratio, which is sitting incredibly low at just 23.0%.
Wow, so they're fundamentally built to absorb the carrying costs of that finished inventory.
Exactly. They have the liquidity and the low debt profile required to just,
Yeah.
wait out the cautious consumer.
All while deploying those sales incentives to slowly chip away at the unsold homes.
Right.
Here's where it gets really interesting. If they are constantly buying down mortgage rates and offering these massive incentives, that cash has to come from somewhere.
It does.
The home building segment is clearly the volume engine, operating at a 12.3% pre-tax profit margin this quarter.
Right.
And their rental operations, which sold 601 single-family homes and 339 multifamily units, brought in $266.1 million at an 11.6% margin.
Okay.
Both of those segments represent the physical reality of real estate.
Mm-hmm.
But let's look at the paperwork. Let's look at the financial services segment.
Yeah. The margin profile here is fundamentally different from pouring concrete.
It is entirely different. The financial services division generated $220.7 million in revenue, but their pre-tax profit margin was an astonishing 31.9%.
That's huge.
Building a beautiful physical house with lumber, plumbing, electrical, and roofing yields about a 12% profit margin, but doing the mortgage paperwork and the title insurance yields nearly 32%.
If we connect this to the bigger picture, this margin disparity is the linchpin of D.R. Horton's entire corporate strategy.
Oh, so?
This vertical integration is what makes moving 24,000 homes in a cautious market viable.
It reminds me of a casino. The physical house is the hotel room they might give you a discount on, but the financial services division is the casino floor where they own the games and the ATM in the lobby.
That's actually a very accurate way to look at it.
Explain the closed-loop system of how that 32% margin essentially funds the discounts on the physical houses.
Well, it goes back to the top-line paradox we opened with. D.R. Horton is sacrificing home building margin to buy down mortgage rates for their buyers.
Right.
But because D.R. Horton operates its own mortgage financing, title services, and insurance agency, they are capturing the revenue generated by those very same transactions.
I see.
So when a buyer uses D.R. Horton's in-house financing to get that subsidized, say, 5.5% mortgage rate, D.R. Horton is collecting the origination fees, the title insurance premiums, and the ongoing servicing value.
Oh, wow. So they are essentially acting as the bank, taking the profit from the loan origination and using it to offset the cash they spend buying down the rate in the first place.
Exactly. They have built a high-margin financial engine that directly subsidizes the lower-margin physical construction engine.
That's brilliant.
Keeping the financing in-house isn't just about making a higher margin on a specific segment. It is the vital mechanism that facilitates the deals.
Because it allows them to offer the aggressive incentives required to keep the massive home-building volume engine running.
Right. They can afford to take a hit on the lumber because they are capturing the highly profitable financial services revenue on the back end.
A completely closed-loop system that is clearly generating mass amounts of free cash flow, which actually brings us to capital allocation.
Yes.
Because despite management pointing to a tough macro environment and affordability constraints, their actual deployment of capital screams extreme corporate confidence.
The way a company spends its cash during a challenging quarter tells you infinitely more than the cautiously worded statements in their press release.
Definitely. And D.R. Horton completely reiterated its fiscal 2026 guidance. They're projecting $32.5 billion to $33.0 billion in consolidated revenue for the year.
Huge numbers.
Massive. They plan to close between 83,800 and 84,300 homes.
Wow.
And they expect cash flow provided by operations of at least $3.0 billion. But it's their shareholder return metrics that serve as the ultimate flex here.
Oh, absolutely.
During this third quarter alone, they repurchased 4.2 million shares of their own common stock for $615.7 billion.
In one quarter.
In one quarter.
Yeah.
On top of that, they paid out $127.1 million in cash dividends, and they declared an upcoming quarterly cash dividend of 45 cents per share.
Right.
Plus, they still have $1.1 billion remaining in their stock repurchase authorization.
So they are returning over $740 million to shareholders in a single 90-day period.
So what does this all mean? If you have 7,600 empty homes sitting on lots and consumer sentiment is, cautious, why are you spending $750 million buying back your own stock instead of hoarding cash or paying down debt?
Well, with a debt-to-capital ratio of just 23.0%, that reduction is simply not a priority.
They don't need to.
Exactly. The balance sheet doesn't require defense. Aggressively buying back stock while reaffirming massive forward guidance, it's the clearest signal management can send that they believe their highly calibrated strategy is operating exactly as designed.
The balancing of pace, price, incentives, inventory.
All of it. They are not pulling back in fear of a housing crash. They are leaning in.
They believe their own stock is the best possible investment they can make with that excess cash.
And the internal return metrics actually support that decision. Look at their home building return on inventory, their ROI, for the trailing 12 months.
Yeah.
It is sitting at a very healthy 17.0%.
Wow.
For every dollar they have deployed into dirt, development, and vertical construction, they are generating a 17% return.
That's incredible.
When your core operational engine is churning out that kind of yield and your balance sheet is unburdened by heavy land debt, you have the luxury of aggressive share repurchases, regardless of macro anxieties.
They have built a machine that is insulated by its own scale and its asset-light land strategy.
Yeah, they really have.
But no corporate strategy is completely immune to external shocks. We have to look at the blind spots. What are the forward-looking risks that D.R. Horton explicitly acknowledges in this report?
Well, the primary risks remain heavily tied to the cyclical nature of the real estate industry and the broader macroeconomic environment.
Sure, that makes sense.
They specifically call out the availability of mortgage financing.
Okay, meaning what?
If government agencies change their standards, or if there is a sudden, drastic, systemic increase in baseline mortgage interest rates, the internal math of their closed-loop system breaks down.
Right, because if the baseline 30-year mortgage rate jumps to, say, 10% overnight, D.R. Horton's in-house bank simply cannot buy that rate down far enough to make the monthly payment affordable for a middle-class family.
Exactly. The incentives lose their power.
And the inventory would freeze.
It would completely freeze. They also acknowledge the ongoing risks associated with carrying land and lot inventory.
Even with the options contracts.
Yes. While their options-heavy strategy is highly defensive, they still have billions of dollars tied up in construction and progress. And those 7,600 finished homes.
Right.
A deep, prolonged recession would turn those assets into heavy liabilities.
That's a good point.
And finally, given their massive national footprint across 36 states, they highlight the unpredictable impacts of extreme weather conditions and natural disasters on their construction pace and financial results.
Yeah, because you can optimize your land options, and you can capture 32% margins on title insurance, but you cannot optimize your way out of a hurricane stalling construction in a major Southeast market for 3 weeks.
Exactly. It remains a physical business built in the physical world, subject to physical delays.
As we wrap up this deep dive into the numbers, I want to leave you, the listener, with a final thought to mull over. We've spent this time breaking down the mechanics of how D.R. Horton uses its massive scale, its options-based land strategy, and its highly profitable in-house financial services to offer sales incentives that keep their inventory moving despite a cautious consumer.
They are a phenomenally well-oiled machine.
They really are.
Yeah.
But consider what that operational advantage means for the broader real estate ecosystem.
Oh, yeah.
If you are an average person trying to sell an existing home today, you have to wonder, are mega builders like D.R. Horton fundamentally altering the baseline of the real estate market?
The competitive dynamics at the ground level shift entirely when you introduce a player with these capabilities.
Totally. By essentially acting as their own banks to buy down mortgage rates and offer massive closing deals, these corporations are creating a competitive baseline that an individual homeowner simply cannot match.
It's nearly impossible.
If a prospective buyer is choosing between your 20-year-old house at a baseline 7% mortgage rate or a brand new D.R. Horton hire where the builder is subsidizing a 5.5% rate using their in-house financial engine, I mean, the individual seller is at a severe disadvantage.
The sheer scale of the mega builder doesn't just navigate the market conditions, it actively dictates the terms of the market for everyone else.
The mechanics of corporate finance eventually become the realities of your local neighborhood.
Very true.
Thank you for joining us on this deep dive into D.R. Horton's third quarter. If you want to keep your finger on the pulse of corporate strategy and understand the mechanics driving the numbers, make sure you follow the show. We provide in-depth earnings coverage just like this every single day. Keep looking past the headline numbers, and we'll see you next time.